know this is probably a big issue with lots of business people and lots of people that have portfolios. Should they be investing in their own name, or should they be investing in a family trust or a company? And as I mentioned earlier, investing in your own name could be risky. Could be risky if you're a professional or you're running a business that has potentially could get sued or is potentially an insolvent company. We don't really see that very often. Most of our clients are running good businesses. But if you want to separate your assets from any other potential liability, then perhaps you should look at, establishing a family trust, getting a family trust settled, so that capital is there for the benefit of your family. A lot of people have done this recently and over the years. A lot of high-profile people do it, and a lot of ordinary Australians do it. We know that the recent government has introduced its own legislation regarding the taxation of trusts. But if trusts are conducted in a genuine manner for the purpose they've been established, then you haven't got a problem. So you may wish to accumulate a portfolio but not gift any money away to children, but you may want to distribute some income from the family trust to the child. As long as that money is properly distributed to the child, there's no problem with that. You may be operating a business and in a company structure. That's appropriate for the company, for that type of business. It's very common. It's not uncommon. There may be a family trust that is the shareholder of that company, which enables the company to pay franked dividends through to the trust and through to the family members. The company, if it meets certain requirements, can achieve a low tax rate of about 25%. Base rate entities with turnovers of less than 50 million, generally can access this base rate entity tax rate. I'll leave it over to Sam.
Yeah, we have a similar experience, I suppose, with individual investing. We typically see that with individuals and families with, perhaps low liability in their working careers or salary roles, where there's no point of creating a family trust for asset protection for tax distributions. But similarly with clients in different situations where they do have more liability, or they do want the capacity to distribute to their children and grandchildren, then some of these structures do start to become a bit more relevant and appropriate. I think the thing to make note of when we're considering structures, companies, trusts, partnerships, individuals, investment bonds, and superannuation is they all have their different purposes and they all have their different pros and cons. So it's really important to make sure that you speak to the right professionals with the questions that you might have before looking to engage further with particular structures. But from a wealth perspective, we commonly see family trusts used, commonly see companies used for one reason or another, and plenty of people investing either in their own name or jointly together as two partners. I think the other aspect that you mentioned, John, around superannuation, we'll see super commonly misunderstood perhaps in the earlier working career, and perhaps not as prioritised as individual investing. And you'll find that these days what you can invest in super and what you can invest in your own name is really similar. Historically that wasn't necessarily the case, but nowadays you are able to do that. And what that does is it gives you access to this tax rate of 15% versus your marginal tax rate, which in most cases is going to be quite higher. And what you'll find is if you had $100,000 in super or in your own name or in a family trust, in just about all circumstances, the superannuation is going to grow faster if all the variables are the same, just because of its tax rate being 15%, and then once we're able to reach that and access that in our retirement, usually somewhere between 60 to 65 for most people, that money becomes tax-free. So you'll find from a wealth perspective, we look at all the structures and what the right timing is for using those, and what surplus income we have and what liquidity issues we might need. But structures definitely form a big part in asset protection as well as wealth accumulation.